Florida, we make a couple of key points here. On Florida, the desired rate increases are not being achieved. The rates were frozen in 2007 when the legislature passed House Bill 1A. They were unfrozen last July, but as we all know, it takes a while to earn that premium through the system. I guess, and I think it's true, a lot of people want to believe it's true, that the bottom probably was reached back in the middle of the year before the rates started coming in, because the full impact of the wind mitigation credits, which had been introduced by OIR in 2008, which was really just another form of rate reduction, following the rate freeze from the year before, and it's really significantly hurt these companies with a lot of premium loss due to needing to give credit for wind mitigation credits, as well as public adjusters reopening old claims from 2004, and it just goes on and on and on. And so the underlying ratios are bad. From a reinsurance standpoint, probably if you're a company in Florida spending 44 cents of every dollar, you're probably doing pretty well. A lot of companies are over 50 cents on the dollar, coupled with the increase in the underlying loss ratio, coupled with the fact that they cede off override into their MGA, the insurance entity is not making a lot of money. And so we'll see whether that changes, as we were talking about. But anyway, think about it from a reinsurance standpoint. What does this mean in terms of supply and demand? We think there's going to be enough supply, but just to run through some of the things that could lead to a demand, the TICL layer of the Florida Hurricane Cat Fund, which isn't mandatory, last year, or rather, last year was the first year, was to come down by $2 billion. And when we saw who took it up at that point because of the bonding issues and would they be able to bond, Citizens bought last year. They're not going to buy in 2010. And about 20%, private insurers representing about 20% of the market bought TICL. So if you just use that as a rule of thumb, if it comes down another $2 billion, you'd say that the capacity is going to go up $400 million right there. There are some other issues with the Florida Hurricane Cat Fund relative to, again, mitigation credits, in that it's geared off of premium and debits and credits, and so it's a long story, but we expect that a number of companies are going to see their Florida Hurricane Cat Fund retention go up, and so there might be a need for TICL replacement a little bit, about 400, at least 400, maybe a little bit more, 500, and then layers below the Cat Fund there could be a need too. But we don't think that the demand is going to exceed the supply or come anywhere near that. Rating agencies, near-term versus long-term, believe it or not, Demotech, they're talking about it, but maybe they'll switch OIR to maybe, concentrating more on the near-term versus the long-term. If that happens, then there could be an increase in demand. And then potential credit surcharges for reinsurers. Kevin had mentioned the way, they look at it, and this is pretty typical, is that pretty much support a lot of the insurance companies in Florida and differentiate based on your line size. I think that absolutely that's what happened last year. There was a lot of talk of concentrating on the credit quality of the primary companies, but I'd say by and large everyone got their capacity, obviously different line sizes, and that will drive market pricing. But I think this year what you're going to see is pretty much everyone covered, but there are going to be a couple companies that may be on the cusp that are really going to struggle for capacity, and so we could see that. And so that's a form of, if the supply is less, the price will be higher. But all that said, we think that risk-adjusted pricing is probably going to move back to about the 2008 levels. We had a fancy, moving chart, which I thought would take too long to go through and everything. But basically, when all is said and done, we think that the increase last year will probably go back down to the 2008 level. If you do that and you quantify it based on the lower layers, middle layer, and higher layers, it's about a 10 to 13% downward movement in prices. And the last comment here is on the size of the market. The size of the market is somewhere between 20 and 25 billion. We still think at the end of the day there's going to be about 10 to 20% overcapacity. Again, thinking back to last year, no one has a crystal ball, but there was a lot of talk about not enough capacity, and everything did get done in Florida with at least 10 to maybe 15% overcapacity in that market.